following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host for the show, David Blain. We thank you for joining us today on 94.1 FM WNBU or Cable TV 10 in New Bern. We've got another great show lined up for you today. Our ideas for the show generally come from you, our viewers and listeners, so if you have any comments or questions on the show, feel free to contact us by phone, 252-633-0107. Our email is allthingsmoney@dlblain.com. That's allthingsmoney@dlblain.com. And of course, you can visit us on the web at www.dlblain.com. There you'll find information about myself, my firm, as well as archived copies of the show. And we do appreciate listening or hearing from our viewers and listeners what's on their mind, things they'd like us to cover, clarification of any topics. So without further ado, let's get right into the show here. I wanted to spend a few minutes today talking about something you may have heard about called Operation Twist. This is a program, a name that people have been throwing around the media about the Federal Reserve to try to help the economy. There's not much left the economy that the Fed can do to help the economy, and so this is something that's been bantered around, Operation Twist. And for those of you that may not have been paying attention back in the 60s or weren't alive in the 60s, Operation Twist is sort of a revival of something that JFK did on a very small basis back in the 60s. And it gets its nickname from the dance move made famous by Chubby Checker in the 60s is where it comes from. But essentially what Operation Twist is where the Fed, they buy longer-term securities and they sell shorter-term securities. And the reason they do this is currently, long-term Treasury bills, 10 years, are yielding somewhere around 3%. And as you know, short-term rates are essentially zero. You're not making anything on the short-term money. And so what Operation Twist would do is attempt to drive the yields up on shorter-term Treasuries. Okay, so with bonds, remember, if there's a lot of increased pressure on selling, you're driving the price down, and so the yield goes up. If you're buying bonds, you're driving the price up, and so the yield goes down. And so if your shorter term, money markets and Treasury bills and things like that are paying nothing, and you want to get that yield up, you've got to drive the price down. And as we all know, hopefully from the show, it's all about supply and demand. And so if you want to drive the price of something down, if you want to drive the yields up, you need to drive the price down. And so they would start selling short-term bonds. On the longer end of the curve, if you wanted to keep rates low or reduce rates, interest rates, you want the rates to go down, so you want the price to go up. And from our knowledge of supply and demand, if you want a price to go up, then you increase the demand, which is buying. And so that is something that the Fed could do, is buy the longer term, sell the shorter term. And what this would do is, for investment purposes, it would keep long-term rates low, which generally set the rates on things like mortgages and long-term business buying, capital investment, credit cards and things like that. And what it would do on the shorter end of the yield curve would drive the rates up. And so instead of getting nothing for your money, it would raise those rates up. The money markets, the interloan banking. And the idea would be to increase foreign investment into the shorter term. They would be attracted, foreign capital would be attracted to the shorter term rates that they could get, because around the world, remember, at least in the developed world, the rates are are very low around the world. And so the theory would be to attract investors to the shorter rates, as well as because of their increased yields, and then increase borrowing on the longer term because of the low rates. And so that, if you hear the term Operation Twist out there, that's essentially what they're talking about. Now, when President Kennedy did it in the 60s, it was on a very small scale and really hard to determine whether it actually worked or not. This sort of thing, some people call it QE3, from quantitative easing 3, Operation Twist. There's a lot of debate as to whether it really helps or not. Of course, the proponents of it say without it, the economy would collapse. The detractors from it say that they're prolonging the pain. They're going to drive up inflation at some point. And then, of course, some people say, well, what's the Fed involved anyway? We should let the free markets determine interest rates. So there's a lot of question as to whether this Operation Twist or QE3 would actually happen. Now, we've seen a lot of volatility in the financial markets the past couple of weeks. We're going to talk about that a little bit in the next segment, but one of the things we saw yesterday was some marginal stabilization, and then today, Tuesday, as I'm recording this, we see the markets are going up, basically on a rise in hope that the Fed will do something. Ben Bernanke last year announced QE2 at a speech at Jackson Hole, Wyoming, which coincidentally this Friday he has another speech at Jackson Hole, Wyoming, and so a lot of people are speculating that they may announce something about QE3 or this Operation Twist, and so you're seeing a little bit of a bump in the markets today. All this stuff is way too short term for an investor to really worry about. I'm just explaining it because it's all over the news, kind of like when we talked about the debt downgrade and default and things like that. It's not something that long-term investors are going to go out and necessarily trade on what Ben Bernanke is going to do on Friday, but we explain it to you so that maybe you have a little bit more information from a neutral source about what is happening. So that's kind of what this Operation Twist or QE3 is about. We're going to talk a little bit in the next segment about things that you can control. One of the things, not only in finance but in life in general, is people get worked up over and worry themselves to death over things they have no control over. If you own Coca-Cola stock or a mutual fund or something like that, you have absolutely no control over whether that thing goes up or down tomorrow. And so you shouldn't be worrying about that. What you should be worrying is things that you can control, things like your savings, things like making sure you have an appropriate amount of risk in the portfolio. You can control the planning part of it, but once you own something, you can't control whether it goes up or down on a daily basis. And so we really encourage people not to overly obsess about it. Well, more on that after the break. We've come up to our first break. So for All Things Money, I'm David Blain.